We're aiming to accelerate the shift to a sustainable world by providing capital that helps build, upgrade, and maintain the real assets that we need in the future, that are aiming to deliver a positive environmental and or social impact whilst generating return. I remember sitting in a meeting, we were discussing how are you factoring in climate change into how you're pricing your insurance premium. And he said, well, if you look at 200 years of data, this is not statistically significant. Therein lied the problem. If you're basing all your investment decisions on a backward-looking view, you're going to make a lot of mistakes when you think about what's going on in the future. We're aiming to generate a double-digit return. That's maybe slightly different to what a lot of people may think about infrastructure. We sort of think low return, yielding investments. I think where we see the opportunity is actually to be a provider of capital because we've got such a big infrastructure spending gap. Only asset class where impact and return coexist and one drives the other, in the sense that it's an opportunity to invest in a space where the asset you're investing in is directly contributing to the impact outcome that you are trying to achieve.
Anish, I want to say welcome to the show. I know you've been working in London for a while now, but where did you grow up?
Thank you, Scott, for having me. Really, really glad to be on here. I haven't moved far. I was born in London, grew up in and around London, so very much Londoner, studied in London too. So I'm glad that the role takes me around the world and some really interesting places where we're investing in some really important infrastructure, because it's good to kind of get out there and see different perspectives. My family background, I'm of Indian heritage, and my parents were born in India, and so I traveled to India quite a lot as a child, and for me that was always an area where I went and I guess really understood the value of good infrastructure from a very early age as a result of that, because you go there and things have changed a lot very quickly over the last 30 odd years, but you go there and you really value the importance of good sanitation, reliable power, roads. And so I guess there was a little bit of a nugget in there in terms of an early appreciation for the importance of the stuff that we're investing in today.
You actually are a Londoner, your primary education also in London?
Yeah, in the suburbs of London. I studied economics at UCL in London, and it was an interesting time. I'd done that around the financial crisis. So it was a really, really interesting time to be studying economics and sort of sitting there going, hang on a minute, does any of this actually work, actually apply? And so that inquisitive piece of me was in overdrive, and sort of I've taken that through to today in terms of how we think about the world and what we're investing in. But it was definitely eye-opening, all this conventional wisdom, and then kind of going, hang on, does it actually make sense in the real world?
For listeners who are maybe living outside of Zone 1, Zone 2 in London, UCL is the University College of London. I imagine studying in the 2009-2012 timeframe was a better time to be studying rather than looking for a job.
It was pretty scary looking for a job in 2012.
What was it like, though, studying conventional economic theory during the great financial crisis?
I have to say the first year and a half, it was very weird because, as I said, it was very hard to learn the things that we were learning and then apply it to what was going on in the world, and realizing that, you know, these models and theories break. It takes time for people to adjust and reassess that. By the time we got to our final years of study, I had skewed what I was focusing on in terms of modules to things that were a bit more practical, understanding Europe and the EU, corporate finance, and the syllabus. You did start to see a bit of a change in the way that the syllabus was being taught. I think today it would be quite different, but it was definitely an interesting time.
You got out of school in 2012, which still wasn't a particularly robust period of time for the job market. And you landed at M&G, but at that point, was it Prudential Portfolio Management Group?
So I'd spent some time whilst at university and even before doing various internships as you do. I'd spent time in some investment banks. I'd spent time in equity research. And as I was leaving university, I had worked out that I wanted to be an investor, which was a pretty bold statement, I guess. But I had realized I wanted to be doing something that was on the buy side and ultimately would have some sort of productive use for the long term. And M&G was one of the firms that had a graduate program at the time, and it's a fundamental long-term investment house. I really like that approach, and so it was definitely getting the role was really exciting for me. In terms of the organization, M&G at the time was owned by Prudential, the UK insurance business, different from Prudential Financial to your US listeners. And so it's an organization that goes back a long time. Prudential was the insurance part of the business that did life insurance and annuities and all of those wonderful things. And M&G was the European asset manager. And so that was the relationship. And over time, the corporation has evolved. And in 2019, those two businesses were both sort of merged together and spun out of the old Prudential business, such that it was an independent listed business today on the London Stock Exchange.
Did you originally go in on the insurance side?
So I joined on the asset management side, but it was quite a joined up organization. And within the group, within the building was a team called Prudential Portfolio Management Group. And they were responsible for being the stewards of all the insurance capital and allocating that across different strategies. And so I ended up joining that team. And the reason I joined that team was because they had a small, relative to the size of the portfolio, it was about an £80 billion portfolio on the kind of multi-asset with profit side. And they had a small allocation to this thing called alternative assets, which when I joined, didn't know a huge amount about. But when I spent some time with the team on my rotations, realized that this was a whole amazing world of private assets in a load of different esoteric asset classes, and really started to take an interest in that. At the time, it was a small part of the overall book, and there weren't that many people focused on it at the time. In fact, there was only one individual. There was a real opportunity to kind of join that team and help build something, because it was starting to become very clear at that point that private markets were going to be a growing part of investor portfolios, and that this portfolio had largely been outsourced from the organization to others, and there was a real opportunity to build something in-house. And so joined that team in 2012 and sort of haven't looked back since. We've taken that from what it was then to, in the real asset space, really building that real assets portfolio. Over that period, we've committed around $4.5 billion of capital, or just over, to various opportunities in the infrastructure, agriculture and natural capital space. And it was just a really exciting journey because it's happened over a relatively short space of time. And we've gone from a fairly nascent portfolio to one that's really grown in sophistication and scale and breadth over time, at the time where the whole real asset space, particularly on the infrastructure side, has grown tremendously. I think when I started, it was probably total AUM in global infrastructure equity funds was probably about $200 billion. Today, it's about $1.2 trillion, and it's expected to grow exponentially from here as well.
What's the macro trend causing that?
I think it's a couple of things. It's demand and supply. So I think most people will have seen the various reports around the world, or will be living the consequences of a lack of investment in infrastructure. We went through a multi-decade period where there was significant underinvestment, and that infrastructure investment gap is in the trillions. And so there is a huge opportunity for private capital to play a role in supporting that, particularly at a time where government finances can't support that alone. That is the opportunity. So there's been a lot of room to grow into. At the same time, I think there's been a realization that doing infrastructure investment through a private capital lens, where you can take a long-term view, where you can have the time and patience to deliver capex for a long-term return, is something that investors have cottoned onto. And at the same time, the return characteristics that the asset class has delivered gets a lot more appreciation. So low correlation to public markets and any other asset classes, frankly, a very broad opportunity set. For those that want income, they can get income. For those that want growth, and increasingly, I think this is the big opportunity. There is a huge amount of growth, particularly as we think about some of the big trends that are going on in the world around climate change, around digitalization, around the changing needs of populations. All of this stuff requires new infrastructure. And through that period, as more and more capital has come into the private infrastructure space, you've kind of ended up with a critical mass where this is now the go-to pool of capital if you need to build or grow infrastructure or operate infrastructure over the long term. And so this ecosystem has been built. It's a good home for the types of assets that exist. And so I don't want to say it's replaced the public markets for infrastructure, because there's an important role for the public markets to play as well. But there is significant critical mass here where we just see it growing from strength to strength from here. And you've seen institutional investor allocations as a result grow from non-existent to, in some cases, double-digit percentages of their overall portfolio.
How did you end up focusing on infrastructure and real assets?
I think I was drawn to a few things. One, its long-term nature and ability to kind of say, if I do this today, it's going to have a positive effect on how something is done or how people can live or communicate or over a really long period of time. Two, it's something you can touch and feel, I guess a bit like real estate. But for me, I'd always had this sort of interest in engineering and that sort of thing, and infrastructure's got a lot of that going for it. So I just took an interest in the assets, and I was like, these are really cool assets to be building or investing in that are going to be around for a long time, that you can talk to people about, you can touch and feel. I think the other thing was there was just within our organization, when you looked at our portfolio, there was just a lot that could be done with it to make it better. And so there was an opportunity for someone to focus on that and help grow it. And so, yeah, infrastructure is everywhere.
How did the impact aspect come into the investing picture for you?
I think it's been very natural in the sense that as we were doing this, we were really thinking about the scenarios in which you were holding these assets for 20 or 30 years or more sometimes, right? And you were going, what would it need to look like? Will it be useful in the future? Will people want to buy it off of us at some point if we wanted to sell? And all of these things, and also where are the growth opportunities? And I think that's the fundamental one. Where are the growth opportunities? As we looked at the space, we kind of just ended up doing a lot of things in energy transition around rolling out fiber networks to rural communities, because that was a good investment opportunity in certain markets. And so when we got to, I guess, 2018, 2019, when we were thinking about setting up the dedicated fund for this, we had a load of stuff in our portfolio that really wasn't labeled impact, but delivered a lot of impact. And our portfolio was definitely skewed to the stuff of the future rather than the stuff of the past, just from a risk management lens. And so when we got to 2018, 19, when we were setting this up, basically our insurance client came to us and said, we would like to use this asset class to improve the overall makeup of the portfolio in terms of things that can be supporting a sustainable agenda. And also we are looking at setting up dedicated strategies within the business that could do with a sustainable only lens of real assets. And so we had a very willing insurance client at the same time where we were thinking, actually, we're doing a lot of this stuff anyway, and it suits our investment style. And I think that's the other piece of this. A lot of these businesses tend to be smaller to start with, because you're kind of creating new platforms and building new stuff. They tend to be ones where you've got a bit of scale up required to CapEx investing or building. And these are the sorts of things that we had naturally ended up doing more of in our portfolio because of our view on where was relative value in the infrastructure space. We'd ended up steering away from a lot of big operating, what I would call trophy assets, because of where valuations had ended up in the market. And so it was just a natural kind of confluence of there's loads of stuff out there. The growth opportunity set is actually in the sustainable businesses of tomorrow. Why don't we set up a dedicated focus on this? Because it's the stuff that we really believe in.
Let's start with a high-level introduction and overview of M&G, just to understand the overall company.
We're a savings and investments business. The roots go back a very long time. I think it's more than 170 years since the Prudential was founded. M&G a little bit after that, but not much after. Today, we've got about $400 billion of assets, both across public markets and private markets. So we're touching all asset classes, really. About 90 billion of that dollars is in private markets. Three main parts of our business. There's the life company, which we've talked about. There's a wealth division and the asset management division. And the idea is that the power of the business really is that we all kind of work together as one, with the life company really helping. There's a lot of assets there that need managing. The asset manager provides that investment engine, and the wealth provides that distribution platform. And so it's allowed us to really be, I guess, in the alternative space, an investor of scale over time and a long-term investor. So that's been really, really powerful and real privileged seat to be in. We're about 6,500 employees. A big chunk of that is in Europe, but we do have offices and investment people around the world.
You have a responsible investment part of it. Where does that fit in to what you just described?
So within our private markets division, we have set up a business called Impact and Private Equity. We are covering three main areas within that division. So real assets, private equity, and growth equity through a strategy that we've called Catalyst. And Catalyst is providing impact growth equity to, I guess, early stage businesses, both in the climate and social impact space. On the real asset side, we've been investing in infrastructure, agriculture, and nature-based solutions. The latter two of those are relatively more nascent, but it's something we've been looking at for a number of years. And across that platform, we've got about 50 people globally. How does it all fit together? We're servicing the long-term needs of our portfolios from the life business and supporting the objectives really they have in terms of returns, diversification, access to private markets. And then over the last few years, we've been really setting that business up to open the access up to third-party capital as well, because we saw a real opportunity of, hey, we're pretty established in the markets in terms of what we're doing. We have really good access to great opportunities, and we could be doing more. And wouldn't it be great if we, particularly on the impact side, if we could open up the engine to a broader set of investors that can't access this stuff? And so we went on that journey of what type of strategy and product would work to open up the pools of capital that can't access private markets, can't access all this wonderful infrastructure stuff that we need for the next 20, 30 years. That's kind of how we fit in. And the impact strategy was really born out of thinking through what are the needs of the internal, I'll call it internal capital, but it's really hundreds of thousands of policyholders, if not millions. And then how could we take that to a broader audience?
You're still managing the assets of the insurance side of the business, but it sounds like it's much broader, and you're actually doing wealth management and you're taking outside investment. It's not all captive.
I'd say of the 400 billion, half of it is coming through the insurance business, and half of it is what you would call external third-party clients. Our insurance business, the main strategy within our insurance business today is a fund called the Pru Fund. It's a big multi-asset savings fund, which is over about £60 billion in size, maybe a bit bigger now. And that strategy is one that really provides the end client, who are your typical moms and pops, an opportunity to invest across a broad range of asset classes in a very smooth way. So we're leveraging our insurance know-how and have created this product that allows a really broad set of savers to benefit from it.
And then on the responsible investment side, is that entirely the M&G impact and private equity group?
It is slightly larger. We've got a few others dotted around the business. On our public side, we have a number of impact strategies and sustainable strategies within the public markets, both bonds and equities. On the private market side, another area that is very focused on this is a business that we acquired a couple of years ago called Responsibility, who were focused on emerging markets, investing across a number of verticals with a very strong impact focus.
Maybe now you can describe in more detail what's your overall investment strategy and if you have target returns and benchmarks.
In a nutshell, it's providing access to a global portfolio of real assets that are aiming to deliver a positive environmental and or social impact whilst generating return. So it's a bit of a mouthful, but essentially what we're trying to do with it is we're aiming to accelerate the shift to a sustainable world by providing capital that helps build, upgrade, and maintain the real assets that we need or think we need in the future. We have committed about $750-ish million to opportunities to date. That is invested today across about 100 plus portfolio companies and projects. So it's global private real asset investments. Our method of investing is through primary funds, co-investments, selectively direct and JV type investments, more bespoke solutions, and secondaries. And we think we do that because we want to build a really, really diversified pool of assets that is, 100 plus portfolio companies. And we want those to be actively managed so that we can deliver the growth and the impact. And so we think the partnership approach works really well. We're sort of, it's going to be about 40% in co-investments and direct investments, about 60% of it in fund investments. We invest across the life cycle, so operating assets as well as construction and development assets. And again, we're trying to blend some long-term yield generating investments that can help be in the portfolio for a very long time with more growth focused strategies that can help scale up the infrastructure businesses of tomorrow and then sort of get them to a level where they should be working with people that have lower cost of capital. And through that, we're aiming to generate a double-digit return to clients. So that's maybe slightly different to what a lot of people may think about infrastructure when they hear it for the first time. You sort of think low return, yielding investments, and actually, I think where we see the opportunity more generally is actually to be a provider of capital to help grow these things because we've got such a big infrastructure spending gap, and that's where we think the risk return really is more optimal.
What do you benchmark against?
Very, very hard to benchmark in this asset class because it's very heterogeneous and people have different kind of roles that they use this asset class for, and so it's a constant struggle in terms of what we're benchmarking against. We think about it more in an absolute return sense these days. If I roll back the clock, I know that people would have used inflation plus benchmarks for infrastructure or even sort of base rate plus type benchmark. We think the public markets are a poor proxy to benchmark these things, and so we kind of focus more on can we deliver an attractive return with really low correlation and one that is helping protect investors against inflation. If we can achieve those things, then we think we've done a reasonable job. And then I didn't mention, obviously, it's an impact fund. So we're very, very focused on making sure that all the investments we make have a very measurable impact on climate and societal outcomes. And that's a keen focus of ours.
What was the opportunity that M&G saw and perhaps you saw it first in real asset impact investing?
I think what was really interesting is on the infrastructure side, we're seeing, as I said, we're seeing a lot of growth in these businesses of tomorrow that all had very much at the center of what they were doing and delivering was a more sustainable solution to something that existed today. And those businesses or projects were getting a lot of support either from government or corporates. And so we saw that as an opportunity. I would say that there was also a bit of a realization that perhaps the financial markets were still playing a bit of catch up to what was going on with climate change. And give you one story that always kind of sits with me. In another part of our alternatives portfolio, we had historically invested in the reinsurance market, right? As we think about alternative uncorrelated assets, investing in the reinsurance market is a theoretically a good idea, right? Weather should not be correlated to GDP. I would argue that maybe that low correlation is probably breaking down and will continue to break down over time because the two become very interlinked. But sort of historically, that's been the case, and so we had been investing in that space. But in the mid 2010s, you had a spate of increasing frequency of natural disasters, and particularly in the US, where the reinsurance market is the most active, increasing hurricanes, wildfires, etc. And I remember sitting in a meeting with some of the industry, and we were discussing this point around how are you factoring in climate change into how you're pricing your insurance premiums. Surely, should you not be thinking about increasing your premiums quite significantly if this stuff is going to happen more often? And the comment that came back always sticks with me, and it was, well, there's no evidence of that in the data. We sort of said, what do you mean? And he said, well, if you look at 200 years of data, this is not statistically significant. And therein lied the problem, in the sense that if you're sort of basing all your investment decisions on a backward-looking view, you're going to make a lot of mistakes when you think about what's going on in the future. And so I think that really spurred us on the infrastructure side to say, no, hang on a minute. This stuff we have been thinking about in terms of the future is important. We shouldn't be sort of thinking statically or backwards, looking backwards in terms of what were the needs of the world back then, and therefore sort of making an inference about today. But really, we should continue to be looking forward and thinking about what are the things that people are missing, because therein lies an investment opportunity as well as an ability to do some good.
How should impact investors think about an allocation to real assets, and what is a real asset in the impact space?
I think it's one of those, I wouldn't say it's the only asset class where everything can perfectly align, but I think it's a really good example where impact and return coexist and one drives the other and vice versa, in the sense that it's an opportunity to invest in a space where the thing that the asset you're investing in is doing is directly contributing to the impact outcome that you are trying to achieve. And I mean, a very obvious example of that is a renewable energy project where I am building or operating something that is delivering clean power. And the better I operate it, the more clean power I'm generating, the more impact I'm having. Is a very, very sort of simple argument, but that holds across so many different sectors within infrastructure. There's obviously infrastructure that generates emissions and things like that, but with this fund, we're very much focused on the stuff where the outcome and the investment financial returns are very much aligned, and that gives us a lot of comfort. So I think people look at the asset class to go, hey, this is a part of my portfolio where if I have got net zero targets, or I've made a commitment to support adaptation to climate, or even social endeavors in terms of infrastructure has a very positive impact on people's lives if managed well, and therefore you can kind of go, we did this and it had measurable outcomes. So I think in terms of measurable outcomes, in terms of alignment with what the assets are doing, it's very good from an impact perspective. And obviously, we talked a little bit earlier about the characteristics, the investment characteristics of the asset class. So it's an area where people are naturally currently thinking about allocating more to, particularly as we've been through an inflationary environment. And so the two things seem to align pretty well.
So now, drilling down on your fund, explain M&G's theory of change.
In terms of theory of change, I think it goes back to the point that we're looking for things where there is an alignment of the business model with the long-term outcome. And I think that's really, really important when we think about impact. If you kind of take the general elements of a theory of change, you've got your inputs. And in our case, that's providing both capital and expertise. And that capital and expertise is going to create clean energy, improve biodiversity, create more opportunities for underserved communities. And the expertise piece is just as important as the capital, because we're partnering with people that we think have got expertise to really grow and scale and improve these businesses. And that has a really positive impact on delivering the outcome. In terms of the outcomes, what are the outcomes of doing those things? It's decarbonisation, it's less stressed natural resources, improved biodiversity, and more opportunities for those underserved communities. And then as we think about the long-term impacts, because again, those two things are aligned, it's not as if we're generally having to worry about, although we do consider it, what happens if we sell the asset? Is that impact still going to last? And therefore these assets, which have very long useful lives, should be contributing to a slowing of climate change, versus if we had not made that investment and improved quality of life to people. So I think that's, again, it just feels like there's really, really good alignment between the investment side and the delivery of those outcomes.
You've alluded to three main themes: energy transition, responsible consumption and production, and social and economic inclusion. So how did you zone in on these three themes?
We wanted the fund to have a very broad reach. We wanted to make sure that we could build a portfolio that was very well diversified. And so as a result, we thought about, looking at the infrastructure universe more broadly, how can we bring together lots of different, what are the key things that infrastructure is doing? Which of those are really focused on driving positive outcomes, where there is a big opportunity set or a growing opportunity set? And then making sure that gave us an ability to put lots of different things together that in itself help build a really robust portfolio. And so we sort of come at this with not throwing investment theory out of the window, but we think these are the real key themes as well that infrastructure can really help solve. And so if I think about the energy transition, I'm sure covered very, very widely on a number of your podcasts, but we're talking about trillions of dollars of investment required globally to build new power, to clean power, to deal with energy consumption, so energy efficiency, to think about how we produce all of our heating and cooling. And heating and cooling is going to become an increasingly important part of this, particularly as the climate changes. How do we decarbonize transportation? How do we decarbonize industry? All of that stuff. There's a massive opportunity set there, and all of it requires CapEx. And so that for us was a really big and obvious one, and it was one we were already investing a lot of capital into. I guess where we'd seen less capital go in, but really saw an important role in the sort of decades to come, was around better use of our natural resources, more efficient use of our natural resources, and protecting our natural resources. And so, again, thinking through what are the impacts the world is going to see over the coming decades in terms of water shortages, as we see changing rainfall patterns and climate, degrading of our natural land. And so we need to be able to produce more food with less, potentially, and we definitely need to protect what we have. And also we produce a lot of food and we waste it. About a third of everything we produce is wasted. And so there was this, again, a big opportunity here around recycling of waste, of water, turning waste into fuel as a way of supporting energy transition and circular economy, in terms of improving our food production system so that they're causing less harm and we're producing better quality food with less inputs. All of those things sort of came together, and responsible consumption became a very obvious area for us to focus on, given what we'd been doing. And then the third piece, inclusion. This one, I guess, is the broadest area of the strategy. It is how we want to make sure that we can provide capital to critical infrastructure, essential infrastructure that is making a difference to people's lives in communities or parts of the population that are underserved. And so that could be just putting in basic infrastructure in, say, an emerging market where got a chronic lack of it, and it could make a huge amount of difference to connecting communities or providing sanitation, those sorts of things. Or it could be that actually there are rural parts of the US that are not connected particularly well with a good internet connection, and that is causing challenges in terms of education, in terms of ability to help those communities continue to thrive, and people are moving out because they can't make that work. And so there's things to do all over the world. There's shortages of infrastructure everywhere, but we use that part of the strategy to really find those opportunities and help scale those areas.
Can you give me just a couple examples of, just to make sure people listening know the type of investment concretely that you're saying is falls into that theme?
Recent investment, and one we're pretty excited about, is a business that's headquartered here in the UK, but is now sort of operating across multiple geographies in the world. And it is doing three things. It is providing electric buses to bus companies and all the related charging infrastructure and software and all of those sorts of things, which are kind of non-core to the bus company, and they need help transitioning. They're doing that under really long-term contracts, so it makes for a really interesting infrastructure investment. Second thing they're doing is building grid-scale battery power plants to help manage the frequency challenges and storage challenges, short-term storage challenges of grids again, and is one of the leaders in that. And the third thing they're doing, and this will become an increasing part of the business as it gets more mature, is they are finding second life uses for batteries. And so battery recycling is a big problem that everyone is going to have to face as more and more of them are produced and they get older, and they're finding pretty useful and innovative ways to give those a longer life and reuse them in different applications. So that is a really exciting growth investment. It's a business that is already a market leader, but has got huge opportunity to support bus companies in other countries, but also expand into different types of large electric fleets.
What about the responsible consumption and production?
An example of the responsible and consumption theme on the infrastructure side would be, we've supported the construction of a biofuels refinery in the United States. The US, certain states in the US are very focused on making sure that they have a sort of green fuels element to their transportation system. This will be one of the largest producers once the project is complete, and helps reduce the carbon intensity of transportation in that state using a type of fuel that's kind of a plug and play into existing vehicles, and so it can have an immediate impact. And over time, that business is looking to make sure that it's using for that creation of that biofuel are increasingly from non-food sources, which was an important factor for us. And on the agriculture and natural capital side, a number of things we're doing there in terms of helping build out sustainable ag businesses at scale that can produce high quality food with less input of fertilizers, with better irrigation systems, better farm management to reduce some of the ecological issues with nutrient runoff and those sorts of things. But I guess one of a slightly newer investment or a newer theme comes from investing in a very large portfolio of forests in the United States, where those forests are being taken out of commercial use in terms of logging and being converted to carbon sinks effectively. And so those forests will increasingly be protected, and the effort is going into managing those forests for tree growth and biodiversity improvements, and then selling carbon credits into the carbon markets.
And what about on the social and economic inclusion theme?
On that theme, we're partnered with a couple of VPs that are focused on delivering new and operating swathes of infrastructure in emerging markets. And so that could be toll road in markets that have had very, very poor transportation infrastructure, which exist around in the portfolio, but also, I mentioned it earlier, rural fiber. And there's a couple of businesses in the portfolio that really have been rolling out fiber broadband to communities that don't have it. This is the new and only provider and allows those communities to be connected to the wider world. And I think when we look at COVID as a really, really good example of the challenges of not having a connection or a good connection for things like education or just being able to work, I think we can all agree that those are important basic needs really for people these days. So yeah, those would be a couple of examples.
What are the return expectations and the risk expectations and the impact expectations for each of these themes? Are they different? And how do you weight the return versus risk versus impact?
So I wouldn't say we have different return expectations per theme. I think we're looking very much for a set of characteristics in the investments that we're making that give us an investment profile that we like, that hits. And we can talk a little bit about where we think there is good risk return, because the whole way we have been running this strategy is a very much a risk adjusted return focused strategy for the last 10 plus years. And so we've been very cognizant not to bucket the infrastructure world in the way that sometimes it does get bucketed into core investments and value add investments. We're really thinking about what is the right risk return for this opportunity. In general, as I said, we're targeting a double-digit return ultimately to investors, which means a lot of what's in the portfolio is very much in the kind of low to mid-teens in terms of expected return, and sometimes higher. And the profile we're looking for generally when we think about risk return is one that has very, very strong downside protection, because we've got assets that are of essential use, and or we've got long-term contracts with very credible counterparties, very creditworthy counterparties, or very, very sticky revenues, because of the essentiality of the asset. So whether we're building something or whether we're operating something, those are the sorts of things we want to look at. How are we protecting our downside? But at the same time, we want to make sure that there is a bunch of value creation levers within the control of the management teams of these businesses and the GPs that we're partnering in with, give us very clear visibility on an ability to grow that. So there's a base level of return that's protected by having the asset, but a real opportunity to scale. And I guess we're generally taking scale up risk and then trying to mitigate that by partnering with the right experts that have shown an ability to deliver that. And that's how you get to your slightly higher returns. And that might be through taking an asset through construction, where we've really, really seen that the construction risk is well managed and a lot of the cost considerations perhaps are passed through various contracts. Or there are opportunities to find pretty small assets and build a platform around it, so require other similar assets to create a scale platform that could be of interest to a larger institutional investor. Or there are assets that are undermanaged and there is an opportunity for someone to go in and really improve that asset so that it is delivering much more efficiently, and therefore improve the return profile from where you bought it. And so that's how we think about risk return, and that applies to all of those themes. And I guess in terms of impact, as I said, this is, make it very clear, we're not in any way feeling like we're having to give up return to deliver impact. I think there is a neat commonality between actually these businesses that tend to be the exciting growth prospects are the ones that are delivering high impact as well. And so the risk on the impact side is very much around execution. Can that business scale and deliver the impact that we expect it to? We do take that risk on. And again, it goes back to the underwriting process and getting comfortable that the people we're partnered with have got all the ingredients to really help that be achieved.
Amongst these themes, how do you consider asset allocation across them?
I would say that we are looking for a very broadly diversified portfolio at the asset level. And so we wouldn't necessarily think about it by theme, because again, that kind of makes the assumption that everything within a theme should behave in a similar way. When the reality is, if we are building community solar projects in and around New York, that has very little resemblance to the bus electrification strategy is doing things here in the UK and Australia. And so we're looking at the portfolio on a more granular level and going, have we got things at different points of the life cycle, different local markets, different regulators that are overseeing it, so that if you ever had a regulatory change, it wouldn't impact a big part of your portfolio, different contract counterparties, such that if someone went bust again, it's not going to have a massive detrimental impact across the portfolio. And that's the lens in which we think about diversification. I think what we'll end up with is a lot of energy transition. That's probably, for the foreseeable future, probably going to be at least half of the portfolio, if not a bit more, because that's the biggest opportunity set. As we see more and more, and we are starting to see more in kind of waste to value and other themes around responsible consumption, that will become a growing part as well. But yeah, we're very much driven by where are the attractive opportunities and then making sure that the portfolio as a whole is well diversified.
I'd like you to describe your typical investment process logistically, tactically, operationally. How do you identify your investment targets? How do you screen your deals? What kind of due diligence process do you do that gets you to the point of pulling the trigger on an investment? And I'd like to particularly understand, both your financial and non-financial screens.
Yeah, absolutely. So I think the investment process won't, in terms of the steps, probably don't look that different to what people would expect. I'd say we consider our financial and impact considerations together. We've set our team up so that it's the investment team leading the impact work, because we just didn't want those two things to somehow be separate or be an afterthought. It's very much, if we're going to source and sift through a lot of opportunities, that's got to be front and center, and people need to help shape these investments that maximize the chances of delivering that impact. And that involves dialogue and negotiation and sort of expectation setting, which the investment team has to do. In terms of sourcing, I guess we're lucky to have been an investor in the infrastructure space for a while now and invest globally. So our connectivity with GPs, with all the usual sort of intermediaries, is very strong. We get a lot of inbound opportunities. We're usually a fairly early call for a lot of the newer GPs that set up, because we've had a long history of backing things early with what we've done. And so we tend to see a lot of the new ideas, a lot of the more kind of complex opportunities, because we tend to get our hands dirty with the investments and really dig deep. And so when GPs have slightly more complicated ideas, we can kind of get in the weeds. So it's about having the right team set up, the right kind of philosophy and the skill set to really understand the asset class. And then as we go through our screening, we're looking for, obviously we're thinking about what's in the portfolio today, what are our deployment needs, where are the gaps. We are speaking to a lot of people around looking at what opportunities are out there, and then sort of on a very much almost a daily basis, working together as a team to kind of sift through and narrow those down to the ones that sound most attractive from an investment and impact perspective, and then sort of marry that with the portfolio fit. We go through our due diligence process. The process varies between whether it's an investment in a fund or an investment in a business directly. And so all the usual diligence items you would expect. When it comes to impact, particularly for the fund investment, there needs to be a lot of upfront work around expectation setting. Does the strategy, because you're investing ultimately a lot of the time in a blind pool, or at least a partly blind pool. So you've got to be very comfortable that what they're doing with that fund strategy over the next 5 years, which is their investment period, is going to align with what you think they're going to do, and that aligns with the delivery of impact, the types of assets you would want to see in the portfolio, etc. We've deliberately not narrowed our universe to self-labeled impact funds, because there aren't that many out there, and actually the opportunity set is much broader. There's a lot of good impact investments being done by infrastructure managers that are not labeling themselves impact, but you've got to be very, very clear with them, or really understand upfront what they're going to do. And then we go through a process of assessing on a fund side the usual, what is the intentionality, the materiality of what they're likely to be doing based on what the strategy is, the additionality, the measurement. Can we measure the impact that they're going to deliver? Are they set up to give us all of that information? We will bake that into legal agreements if we have to. And so all of those sorts of things are done to kind of shape a deal and make sure we're comfortable, particularly on the fund side, where I said there's a little bit more room for things to kind of deviate from expectations. On the co-investments, it's a bit simpler. You know what the business is. You can come in, you can do your review. We use IMP 5 dimensions assessment as part of the process. Across all of the investments, we think about the scoring them on an ABC metric, a 1, 2, 3, 4 metric. It's not the most perfect way of doing things, but it gives us a crude idea of how that impact stacks up. And then we can move on to ongoing monitoring at some point, but we review this stuff annually, and we'll go through the whole portfolio company by portfolio company, and check that things are meeting our expectations. We've done all this in the context of, we spent 2 years setting up our framework for impact investing, because when we looked at all the stuff that was out there, all the literature, all the good work that had already been done, it was actually quite difficult to find things that were tailored to doing private market fund investing. There's a whole host of additional considerations and nuance to it. And so I think we leveraged what we could and we took best practice from what we could, whether it was UNDP, whether it was IMP, but we ultimately had to come up with a framework. So that framework really, really helps direct where we go with the diligence.
What does impact washing look like to you? And is that even a thing in real asset impact investing?
It's an important consideration. I would say the key for us is intentionality. What is the intention of the purpose of that asset, the intention of that fund manager with the assets it's going to acquire? So I think it is definitely a consideration. I think it's mitigated to a large extent in a lot of what we do because of that alignment we've already talked about between what's good for the company is also positive from an impact perspective. And so there's a very clear purpose. I also think there's a risk that the word gets a little bit overused to describe things that were kind of well intended at the start, but then didn't work out from an impact perspective. And so we're very clear that we are, like you take investment risk, we're very clear that we are willing to take impact risk, but it's got to be done in a very calculated way. You've done your upfront diligence. Sometimes these things don't quite work out in the way you would hope, but if you've gone in with the right intentions, that's what's important to us. And I think also, technology evolves, scientific research evolves, and what might have been a good idea today, in hindsight, looks like it was a not so good idea in the future. But I think for us, it's important to keep pushing forward and do the best we can do today, because I guess when we look at the landscape, we don't have a lot of time to fix some of these existential problems. And so the risk of kind of looking at everything through an impact washing lens is that you end up doing nothing. And so we're very much about, not making sure perfect's not the enemy of the good, but doing it in a very measured and well-researched way.
What is your exit strategy and how do you approach your investment exits?
We're ultimately partnering up with people that are driving that value creation and ultimate exit. When we think about exiting, we think about what is the pathway to exit when we go into a new investment. As I said earlier on, we've got a blend in the portfolio. Some assets we would expect to hold for kind of 10 plus years, and others we would look to scale up or do the improvements and ultimately expect them to be exited in a more kind of 5 to 7 year time horizon. We like having both of those. One, it suits the open-ended fund strategy because you've got a natural churn of the portfolio, which generates liquidity that you can think about reinvesting or supporting kind of client needs. But also we just find that incentives work quite well on a slightly shorter term time horizon. If you're holding something for 15, 20 years, the people that are making the decisions today probably aren't going to be around at the end of that. And so we quite like having a view that we can kind of go, right, these are the people that we are entrusting to deliver this strategy. And ultimately we will move on and decide whether we want to, at that point, have a decision point. Do we want to, sometimes we get the opportunity to kind of roll it and stay in, and other points it will get exited. The other piece to this is also climate risk. And as we think about parts of our portfolio, we are trying to deliver assets that are going to support decarbonization and help adapt climate risk. But, the world is going to change in ways that maybe we don't really fully understand today. And so having the flexibility to know that your investments are going to deliver value over a shorter time horizon, but you could hold them for a longer period is how we underwrite. So we always underwrite with the assumption, like, what does it look like if we couldn't sell this? But ultimately, a lot of the kind of growth is nearer term, and we can kind of recycle that capital into the needs of the world 5 years from now.
Is there anything you do to make sure you're investing in businesses whose impact can be preserved long after you have exited?
It could sound like a broken record, but this really goes back to what is the purpose of that asset. And so if the purpose of the asset is to deliver clean power, the asset purpose of the business is to help electrify transport, and that is how it makes its money, then the next buyer is not going to stop doing that. And so I'm not saying that's the case in 100% of the time, but that is what we are very much kind of thinking about and relying on in terms of protecting the long-term value of this asset should be linked to a long-term positive good. And if those two things are aligned, then that is less of a risk. But questions around who your next buyer is going to be, how are our GPs thinking about that, is something we ask in diligence. And so if we do have a concern over that, that is a flag that we would need to consider.
It appears that you're measuring your impact against the UN SDGs, measuring impact or performance or outcomes against the SDGs are notoriously done in many different ways. Do you rely on managers doing the reporting on this?
I think measurement is a big topic for private markets in general. How do we get consistency of measurement? How do we make sure that a lot of these private businesses, again, we're investing in things that are small scale quite often to start with and then scaling up. So when they are acquired or set up, there perhaps hasn't been measurement before, or they don't have loads of resource to go and do a full kind of comprehensive measurement exercise. And that would not always be a good use of company resources, right? If it's detracting from the ultimate goal of delivering the project that is delivering something good. So I think there's a few challenges that the industry has to go in measurement. We picked the SDGs as a way of giving us a lens. It's not the only lens that we use, but it gives us a view of the portfolio because there were a broad set of different targets that infrastructure and the assets we expect to invest in touch and can deliver a measurable outcome against. And so when we look at it, we don't look at we're not kind of stuck at the headline level of SDG 1 or SDG 8. We are looking at the sub-targets. So when we make an investment, we're looking at which sub-targets does this align against? Are we comfortable that it will deliver against those in a measurable way? And then as we go through our annual assessment of how are things performing from an impact perspective, we are collecting data from our GPs and in turn who are collecting data from their underlying portfolio companies. And as I said, we've sort of set this all up front in terms of expectations. We look to try and make sure that it's sort of set in our legal agreements with those partners that we will receive this information. And frankly, the partners we're working with care about this stuff, so it's not necessarily that difficult an ask. But we are receiving that information and then we are doing the assessment on our side. And so we have people within the team that are reviewing all of this information that's coming back on over 100 underlying portfolio companies and going, does this map against the right targets that we thought it would? Or if we have new portfolio companies that enter the portfolio, which happens as it develops, what do they map against? We're doing that on the desk, again, back to the sub-targets and then looking at the measurement KPIs against that. So I know the SDGs get used very widely and I guess fairly inconsistently, but we've tried to be quite focused about it and make sure it's used in a useful way. And then, as I said, it is complemented by a whole swathe of other impact and sustainability data that we're gathering so that we're looking at it through all of those lenses. And ultimately, that results in a score each year for each portfolio company. And we measure that over time. So have things improved? Have they delivered? If not, they get downgraded if things are moving away from expectation.
Could you share maybe one example of an investment that you've made, how you got there using your investment methodology?
Perhaps touched on one of these already. If I think about the co-investments that we've made in the bus and battery business, I'll also bring in a fund investment to give a slightly different flavor. But in a nutshell, on the electrification and battery business, the opportunity came through one of our existing GP relationships. It is a company. First of all, what do we think about the return prospects of that business? And then also concurrently, how do we think about its impact delivery? So we're doing all of our investment and financial and commercial underwriting on the business, its prospects. The thesis here being that there's a lot of electrification of transport fleets that needs to happen. It is not core to those businesses that use those vehicles to do this, and it requires a lot of capex. And then these electric vehicles do need a lot of optimization in terms of making sure that they can be charged at the right time, that they can manage all the routes that they need to manage. So there's a lot of complexity around this, and this business is a bit of a market leader in the space. We were coming in to provide, alongside a number of co-investors and another sponsor, growth capital to kind of allow it to continue winning contracts. So, that means more electric buses, other electric vehicles. It means more projects on the battery grid infrastructure side, where they had a very extensive pipeline. So again, when we think about sort of the investment characteristics, good, solid existing business with long-term contract, good growth prospects, and a management team and a partner that had already been executing on this and could show that the business was on the right trajectory. And so that defensive asset base through the contracted nature, and then the growth through all the opportunities through the existing secured pipeline that it had on the battery side, and then all the opportunities on the bus side. So that would be from an investment perspective. And then from an impact perspective, how did we think about it? Well, transportation emissions is a key, hard to abate sectors. A lot of capital needs to get into that very quickly. There is not a lot of businesses that are around that can help do that at scale. We think this could be one of those, a market leader. And so there is an opportunity to provide primary capital, so new money going in to make those new contract wins and new projects a reality. So the impact thesis for us there was pretty clear. We obviously, there's a lot of considerations to kind of think through in terms of the ability to execute on that. Will that impact be delivered? But that's the same consideration as, will the business plan be delivered? A number of things about what are you going to do with those batteries after the end of life, because we know we're creating a potential waste problem in the future, and the fact that they're doing something with second life batteries was definitely a big positive when we thought about long-term impact.
What is your average ticket size of your investments?
It will obviously vary depending on where we are in our life cycle, because it's an open-ended fund, and what capital we have available. Today, we are typically across, because we can leverage both portfolios, we're typically investing north of $50 million into our fund investments, $30 to $50 million into our co-investments. A size that is not the largest infrastructure investor in the world, but we quite like that. It's a size and scale that is meaningful to delivering outcomes and can really help accelerate businesses and also help accelerate the fundraising of these GPs that we're partnering with. As I mentioned, we're going into some of these things quite early as an early institutional backer, and that can help crowd in a bunch of other capital. So we haven't really talked about that, but there is an impact that we as a fund are having on crowding in capital into the space. It allows us to actually be a meaningful player in this kind of small, lower mid-market and mid-market infrastructure space that we like a lot, because the low-hanging fruit in terms of scaling and improving those assets, we think is a lot clearer to see, and then ultimately build something that can be sold to a cohort of larger infrastructure investors.
I think you had an example of a fund investment.
A fund investment, again, maybe one that we've recently done. There's a credit investor in the US that it launched a growth credit focused strategy supporting infrastructure businesses. Now, it's a bit of a mouthful, but what essentially they're doing is providing non-dilutive growth capital and participating in sort of the success of those businesses through warrants and revenue shares and those sorts of things. Because they're focused on this growth area, what the businesses that they're ultimately investing in are slightly more novel forms of renewable energy, businesses that are doing loads of interesting things in recycling and looking to scale, businesses that are helping with greening industry, all at a slightly earlier stage of their life. That early stage of life, again, if you think about primary capital, scale-up capital, there's a lot of impact that is being delivered. And a couple of examples they've got, when we were doing the underwriting, a business that was building modular tidal power units that would sit on lakes that were affected by the tides and generate power. And these were under very interesting long-term contracts with utilities, but it's a more nascent technology that needs scaling up. And then another business in there is a company that is effectively bought up old telecommunication cables that are under the sea around the world. They are reeling them back up, recycling the copper, so reuse of copper, copper recycling, given the importance of copper in the energy transition, is really, really important. There's actually a positive biodiversity impact of getting the plastic that this thing is wrapped in out of the oceans as well, because that can degrade. But this was a company that had a massive amount of this cable that they'd now owned to dig up, but only one or two vessels to do it. And so this capital allows them to do this much faster. Again, when we think about it from a fund investment perspective, we're looking at, does that strategy align with delivering impact? In this case, there was some really, really good evidence that it did. Is the manager going to be able to measure that impact? Can we put in place things that allow us to review that? Does the manager have the right intentions with the businesses that it's investing in? And then fundamentally, do they have the right skill sets to deliver in this area? And that's about the normal due diligence that you do on anybody. So that gives you a bit of a flavor of some of the fund investments that we've been doing.
Are carbon and biodiversity credits changing the playing field for investing in the real assets impact space?
It's an area of the market that's getting a lot of attention right now, and I think rightly so. I think as we think about the bigger picture here in terms of what we need in the planet, our analysis really said, food systems are at risk. The importance of investing in the natural world is really, really important. And I think it was the World Economic Forum last year that put out that piece that said half of the world's GDP is moderately or highly dependent on nature or nature services. And so this stuff is important, and it's important we protect it because it's got an immediate feedback loop to the whole investing side of things. If we can store more carbon, or if we don't protect the natural resources we have today, that carbon problem becomes bigger and bigger and harder. So the two, we see it as a really important thing where, you can do the things on the infrastructure side, but you can't not think about the natural capital side. And so I think with that context, the carbon credit markets and the focus on it in terms of creating those markets and biodiversity markets is really important and a real positive. However, these markets are really, really nascent. And so therefore, there's been challenges along the way so far, and not all things have worked out. And you've got to be really, really careful as an investor as you look at this space to really understand what it is you're investing in and whether it's going to deliver on ultimately the outcomes you think it's going to deliver. And so I think that's where a lot of the scrutiny has started to come in, and I think that's important. I don't agree with the view that we shouldn't be having these markets and we shouldn't be thinking about this, because we need to put a value on nature such that we encourage private capital into it to protect it. And so when we think about some of just to talk through some of the things we thought about when we were making our investments in the space, really understanding the baseline. What are we investing in today? Where was it? And therefore we've got something to measure an improvement against is very important. And then permanence. The different projects to different degrees have, different validity around the science around permanence, or could be vulnerable to that carbon that is stored ultimately being lost. And that's a really, really important consideration. And we're seeing increasingly that the market's starting to differentiate between good quality projects from a permanence perspective to less good opportunities. And so we hope that continues, and that differentiation I think will be helpful. And then hopefully the capital is then sort of focused on the things that work. But it's a journey. We're really at the early part of this, and it's something we're keeping an eye on.
What does competitive advantage look like in the real asset impact investing space? Pretty much
the similar reasons for competitive advantage in broader real assets, so not just impact, but I think it's a very heterogeneous, diverse market where you can deliver all sorts of outcomes to your ultimate investment portfolio. And I think that's the beauty of it, whether you want long-term income growth, whether you want different size brackets, different sectors and geographies that you can invest in. So, there's a flavor for everyone. And I think for us, the real advantage with all of that choice comes complexity, I think, fundamentally. And so I think for us, it is about access to the deal flow, the best experts, the best partners, For us, having scale and long-term capital is really important because we can be a much more reliable partner. And then having a clear investment approach to navigate all the complexity and all the nuances in the different markets, whether it's different regulatory environments, different assets and types of assets work in different geographies, depending on what their starting point is. And so there's a lot of kind of understanding and research that needs to go into, is this the right infrastructure strategy or the right business model for this market? And so I think navigating that complexity and then kind of layer on impact on top of that, where things are evolving, technologies are changing, how you decarbonize one country over here might be a different pathway to how you decarbonize another country over here. All of that complexity, you just need to have, a clear framework, the right team culture to always be inquisitive and always challenge and think about not trying to oversimplify things, I think is the key for us. And having that engagement with the best partners. There is a lot of dispersion of outcomes in private markets generally. I don't think that applies any differently to the infrastructure space. So this is about working with the right partners, being able to assess who those are to get to the outcomes that you deliver.
I've got a few short answer rapid fire questions I wanted to ask you to wrap up our talk. So just give me the first thing that comes to your mind. But if you had to name the single most important challenge in the real asset impact investing space at this time, what would it be?
Yeah, I think it's the complexity. I think there is a real risk that we let perfect be the enemy of the good and we don't keep pressing on delivering outcomes. And I think the evolution of what is impact and how that changes over time is something we've got to definitely be mindful of, but we want to do the best we can today. And so I think navigating that complexity is definitely a big challenge.
What do you know now about real asset impact investing that you wish you knew when you showed up at Prudential in 2014? And what did you think was important then that you now know isn't?
Probably the role of people and your partners in all of this. Like, I think when you start out, you spend a lot of time focused on the quality of the assets, right? If it's a good asset, a good strategy, it's bound to work. And I think what you realize over time is the ability to execute on that strategy and the quality of the people and the culture that they bring. Whilst this is an asset class about physical stuff, it still boils down to kind of the human and people side of things to deliver it and make sure that people are aligned and motivated and have all of it, are able to bring in the right people when they need it. So I think we spend a lot of time thinking about the people we're partnering today, and I think that stands us in good stead. In terms of things that I thought about then that aren't important now, that I'm not sure if I can think of a good example of that.
I think you said that the quality of the asset or the strategy was more important than the people. And it's like you've now shifted.
I mean, if I look at the portfolio outcomes, they've all been by and large very, very positive. So I think it was always a consideration, but we've definitely seen that, particularly when you're thinking about growth and delivery of pipeline, the better the people you have, or the more aligned the people you have, the more likely you are to achieve those outcomes.
Can you describe to me an example of an investment that you were convinced of at the time you invested, that it ticked all of your impact boxes, but in the end it didn't turn out? And what was the lesson learned from that experience?
I don't think we've had an example yet where something's completely failed from an impact perspective. But what I would say is, there's a more general comment. Again, it goes to this kind of scaling point. The delivery of that impact and the value of that primary capital going in is ultimately that you execute on the growth plan. And there have been a number of instances, not materially, but a few instances where you perhaps haven't quite hit the targets that you thought you would hit from the outset, and you've had to pivot a little bit or scale back your expectations for where you could grow that to. So I think that is more about execution risk across the style of investing that we're doing.
And now the converse of that, can you describe an investment that you had some level of skepticism either when you invested, or maybe you ultimately didn't invest and you passed on it, and in the end it turned out way better than you thought, and you were pleased you invested, or if you had passed on it, you wish you hadn't? And what did you learn, or what was the lesson learned from that experience?
There's actually one example that comes to mind that we ended up passing on for our impact fund, but we ended up doing it in our general real assets fund. I didn't pass the impact review at the time. The business leases water pumps and water management equipment to utilities and the construction industry here in the UK. And there was a real climate adaptation kind of view that we had on this, in the sense that, well, a couple of things. One, the water utilities here in the UK are not in a great place. That's widely publicized. And therefore, lots of leaks, lots of need to kind of manage kind of various pollution issues. And then on top of that, we've been having an increased frequency of flooding events as a result of higher rainfall, and also, infrastructure that perhaps has been underinvested in for a long time. And so we saw this business as one that could really help with kind of climate adaptation. It was going to need to provide more and more services to these utilities to prevent environmental disaster or manage a response to a flooding event or something like that. And so that was quite a neat thesis, but at the same time, the business was doing these other things in kind of construction and supporting the construction industry. And ultimately, we decided that the revenue mix and the kind of, there wasn't a clear intention to refocus the business on the utility side sufficiently, such that we could go, yes, this is a climate adaptation investment that would fit the impact portfolio. So we passed on it, but we did it in the other portfolio. Now, sort of fast forward 12 months, and we've had one of the wettest periods in London that I can remember. It's been an obscene amount of rainfall. At the same time, we've had tighter regulations on the water utilities. The demand for this business from that segment has gone up tremendously. And today, that business, in terms of its mix and makeup, looks very different. And, if we look at it in hindsight, we're perhaps being a little bit too harsh about our initial assessment, given that, there was a view that this would be really, really important from a climate adaptation point of view. So I think the lesson there is, well, one, you have to get comfortable with the intentionality, and we didn't in that perspective, and that's fine. But there is something to be said for really thinking through, what does the business look like today and what could it be? And really thinking about your capital as something that can have a transformative change in those instances, or kind of thinking through, what could this look like in 5 years, and be willing to take that risk sometimes.
So is this an example of perfect being the enemy of good?
Perhaps. But look, we really, again, focused on that intentionality piece. And I think with the information at the time, we probably did make the right decision, but it's definitely given us food for thought going forward.
And if someone wants to get into the real asset impact investment space, how would you advise them to get into the business?
Look, I think the really positive thing here is that this is an asset class that is going to continue to grow and grow in a very big way. So there are today a lot of dedicated infrastructure, private investment firms or teams within larger organizations that are focused on this stuff. So the opportunities there are definitely greater, and a lot of them are looking to continue to grow and expand their teams, because there's more and more capital coming into the space and more things to do. So I'd say, if you're interested in the space, definitely kind of look some of these people up and see what opportunities are out there, because it's a good time now. Fundraising has been more challenging for all private markets in the last 18 months or so, but we're really seeing green shoots in the infrastructure space, and it's definitely been a lot more resilient than some of the asset classes. But beyond that, I think the skill set is largely the same as for many other investment roles, and particularly in the private markets, it's the usual financial skills. I think having an appreciation or for kind of the fact that these are assets that are kind of have moving parts to them, and that appreciation of the engineering is quite helpful, because you can make a model on a spreadsheet look really good, but if you haven't really thought through the practicalities of implementing that or delivering that, it can sometimes take you in the wrong direction. And then if you're thinking about a role on the kind of fund investing side, then or even working with some of these portfolio companies, I think shouldn't underestimate the role of the soft skills. As I said before, people are really important in all of this, and getting to know people, And it is a huge part of investing in the space. And I'd say the final thing is you got to be comfortable in taking a pretty long-term view. You're not going to necessarily know if you were right 7, 10, 15 years until that sort of time down the line.
Well, Anish, I think we got there. We got to the finish line. It was great talking with you. I really appreciate you taking time out of your day to come and sit down and tell me all this. You got great stories to tell. I learned a lot.
Thank you for having me.
Yeah, my pleasure. Tell everyone your websites and social and all that good stuff.
So in terms of website, M&G.com, I believe. In terms of contacting us, M&G are on LinkedIn. In terms of contacting us, realassets@mng.com is the best way to do it.
Right. And what about if someone wants to contact you? What's the best way for them to do that?
LinkedIn.
All right. Well, thanks again.
Thank you, Scott.
And goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.